QuickBooks Pro Plus Desktop 2022 OneNote presentation, credit memo form with inventory. Let's get into it with Intuit's QuickBooks Pro Plus Desktop 2022. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, icon, left-hand side, topic introductions, 1422 credit memo form with inventory tab. Also take a look at the immersive reader tool, topic introductions, also in the text area, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Also note that we usually have the same name and number in the topic introductions as presentations, this one being an add-on or another number because it's going to be following up on the 1400 credit memo information that's in the presentation, this time focusing in on a situation where we have inventory. Topic introductions designed to give an introduction to the topic, provide screenshots, and to take a look at the accounting background to support the information that we'll be covering within the presentations. Closing the icon on the left-hand side, we're going to be looking at basically the accounting related to the credit memo, but this time with inventory, focusing in on the inventory. So when we think about the credit memo, if we look at the screenshots with regards to the QuickBooks software, we're thinking about a situation where an invoice has been entered, and then we're going to be reversing the invoice. So there's a bunch of different scenarios that you can think about with regards to the credit memo. One would be that you have an invoice that you're going to be reversing before the payment has happened. Then when you issue the credit memo, you're going to be reversing it, including a reversal to the accounts receivable, which if you have not yet been paid for the accounts receivable, will go back down at the point in time that you issue the credit memo. Or scenario 2, you have the situation where you had invoiced someone and they had already paid you, or possibly you entered a sales receipt and they have already paid you, and for whatever reason you have to return and give the money back or negate, reverse the sale. At that point in time, you're not going to be reversing the accounts receivable, but rather you will be having to give them some form of payment in the form of a check or something like that, or some kind of store credit. The other scenarios that we can have is that we have a service item, for example, that we issued the invoice for, which would be a more simplified transaction that we looked at in the prior presentations. The invoice then increase in accounts receivable, other side going to sales, and then the reversal of that if someone says that we need a refund for whatever reason for the service item, the credit memo then would basically reverse that scenario out, reversing the accounts receivable, other side either going to sales or possibly bad debt expense if we make a slight change in that instance, which in QuickBooks would be done with the items, which we'll talk more about in the QuickBooks presentation. So you can use this credit memo screenshot as a kind of guide towards that. And then the more complex scenario is one in which we have inventory, in which case we issue the invoice that has inventory involved, that being a larger transaction. That's the one we'll focus in on here. Then in the future, the inventory is returned and we have to reverse not only the sales, but we got to do a sales tax and we have to deal with the inventory that's being returned. Let's first just consider the invoice. If we saw an invoice like this, as we've seen in the past, there's kind of a lot going on, even though the data input is fairly straightforward. The invoice would be increasing, in this case, by the $10,000 to the sales item. The accounts receivable, however, would increase by the amount including the sales tax by the $10,775. The difference then going to a payable of the $775 in this case to the sales tax payable. Then we would also have an amount decreasing inventory driven by the invoice, but the number not on the invoice driven by the item, and that would be decreasing inventory. The other side then going to cost of goods sold, the expense related to us consuming the inventory to generate the revenue of the $10,000. So if we were to reverse that, we can then use a credit memo to reverse that out. And the way we want to think about it when we reverse it out is to reverse the entire transaction that we saw in the invoice. In other words, you don't want to look at the credit memo generally and think about it as if you're just going to pull the journal entry out of your head without first thinking about the invoice. That's difficult. It's unnatural because the credit memo is going backwards. We don't usually think in that way. The way you want to do it is first think about the invoice, write down the transaction, then reverse the transaction exactly in your mind with the credit memo, making any tweaks that you need to make, including possibly not reversing the income or sales item, but rather in this case taking it to bad debt or possibly allowance for doubtful accounts for the return of the inventory. Let's look at that with regards to journal entries and see if we can break this down and make a little bit more sense of it. So here's the transaction that's related to the invoice. So if we issue the invoice with inventory, we're going to have an increase to accounts receivable, we're going to have an increase to the sales, and then we're going to have the sales tax that would be involved. So let's first think about the sales tax here. Let's pull up the trusty calculator. Trusty calculator for some trusty calculation. Let's say the sales was $488, the sales price that we charge, and let's say the sales tax, I think I said was 0.08, and that would give us about that 39 of sales tax. So then we'd have the 39 plus the 488 would give us the 527 receivable that we would expect to be receiving. We also have the inventory going down by an amount that would not be on the invoice, but driven by the item on the invoice if we're using a perpetual inventory system recorded at the same time, and the debit going to the cost of goods sold. Recording that out to the trial balance, assuming this is the beginning balance, our adjustments, and the ending balance, then we got the accounts receivable here would be increasing the accounts receivable 2,000 going up by 527 to 2,527. Then we've got the sales tax payable going up down here, the payable going up from 0 to by 39 to 39. We have the sales going up on the income statement from 200,000 by 488 to 204.88. That then part of the net income, or is included in net income, meaning net income would be increased by calculation of net income, revenue credits minus the debits of expenses. This represents a credit balance with the brackets, not a net loss. It would be going up by the 488, and then we would have the cost of goods sold representing the cost of the inventory that we're consuming in order to generate the income, increasing from the prior balance 160 up by the 375 to the 160,375. That means that the net impact on the net income is an increase of 488, the sales amount minus the 375, the cost of the inventory, net change, the 133 net increase, the 113 net increase in net income, 24,710 to the 24,823, decrease to the inventory 375. Here's the inventory at the 4,375 minus the 375 to the 4,000 even. Scrolling down in the subledgers, we'd have the accounts receivable subledger went from 2,000 up by the 527 to the 2,527. Sales tax payable went up to the 39 in the GL. Sales went from the 200,000 up 488 in the credit direction to 200,488, and the cost of goods sold went from 160,000 up by the 375 to 163,375, and finally inventory went from 4,375 down by 375 to the 4,000. The accounts receivable account up top would also have to be broken out by subledger, customers who owes us the money. We've got customer 4 with the activity here going from 0 up by 527 to 527, the 600, the 527, the 400, the 1,000, adding up then to the 2,527. We also then have the inventory that has to be tracked in the subledger. We're saying that we sold the second inventory item, 2 inventory items we're assuming we sell here, item 1, item 2. Second item was sold, 15 units we're assuming sold at $25. 15 times 25 gives us the 375. That 375 is the amount that was decreasing the inventory here, not the sales price, but the amount of the inventory that was sold and the cost of goods sold. So that was the cost of goods sold calculation. We had 75 of those units, minus 15 gives us 60. We had 1,875 in dollars, minus the 375 gives us the 1,500 for a same unit price of 25. Unit price not changing because there hasn't been any change in the value of the inventory over time. If there were, we'd have to use some kind of assumption method, flow assumption. The common method for the desktop version is a weighted average method. the 1,500 and the 2,500 for our two inventory items, adding up to 4,000 on the inventory subledger, which would tie out to what is on the trial balance. Okay, so now that we have the whole invoice kind of set up, now we're going to say, okay, the credit memo, if we were to take that invoice and reverse it, these are not the same numbers on the example credit memos, but we would have a credit memo which would look something like this, that would be reversing the items that we have here. We have to do a little bit of tricky business with regards to the items in order to get the credit memo to work. We'll talk more about that in the QuickBooks presentation, but in essence, we're using this first line item to reverse out the cost of goods sold and the inventory, and the second one to not reverse it to sales, because we would rather have it go to our other account, either bad debt or sales returns and allowances, which is what we'll do in this example problem. So remember, what you want to do then when you do the credit memo and think about what's going to happen in terms of the accounts that are impacted is first think about the invoice and then reverse it exactly, step one. And then step two, what you don't want to do is try to rework your second reversal by putting the debits on top first, because then again, that makes it way harder for you to think about it. Just do it the same from top to bottom, reversing the debits and credits, which you might say in your head, I can't do that because I was told debits have to go on top. But that's only a convention. That doesn't have to happen. And if you put the credits on top and it's easier for you to figure out, do that. And then if you need to present it to somebody else and they want the debits on top, then do the third step of putting the debits on top and the credits on the bottom, making it look nice. First, do what works. So what works is first thinking about the transaction for the invoice, then reversing it entirely, making any small adjustments you need to make, which might include taking the sales account, not decreasing it exactly, but going to some other account, such as bad debt or sales returns and allowances in this case. So the accounts receivable was debited. I'm going to credit it with my first transaction on this journal entry. Then we got the sales tax payable was credited. We're going to debit it. And then here's the twist. Sales was credited. We're going to debit it, but not sales exactly, because sales generally only goes up. And when it does go down, we'll often make some other account like bad debt expense, or in this case, sales returns and allowances, which is in essence a contra sales account, meaning it's a sales account. It's going to net out to the sales when we put it on the income statement, but it always has a debit balance. It in essence acts kind of like an expense so that we don't have to decrease the sales account itself. Then cost of goods sold was debited, so we're going to credit the cost of goods sold, which is in the wrong, it's in the wrong column, but at least we got the credit correctly with the brackets, so it should be in this column, but the credit in terms of brackets is correct. And then the inventory is going to be debited, which once again should be in the other column, but it's correct in terms of the format of it, in terms of it being non-bracketed. So then you could take that information and put it into debits on top and credits on the bottom, which would be the sales returns and allowances, for example, the sales tax, and then the accounts payable. And again, these two are backwards in terms of the credit is correct in terms of the brackets, but it should be in the credit side and this should be in the debit side. I apologize for that, but it'll post out correctly due to it being the right signs. So let's go ahead and post that out. In other words, if we were to post that out, of course, the activity between the invoice and the sales receipt would net out in all accounts, except for, because we reversed it exactly, except for the sales, because we didn't reduce the sales. So the sales that was there from the invoice still remains. The sales returns and allowances now, a contra sales account, is going to be the one right below it, which means the net in terms of the net debits and credits and the impact on the income statement will reverse out, but you'll now have these two accounts breaking that information out. If you look at the accounts receivable, then we got the 2,000 that went up by the invoice for the 527 to the 2527, went back down by the 527 to the 2,000. The sales tax payable went up by the 39 to the 39, then goes back down by the 39, back to zero. Sales returns and allowances now goes up by that 488. That's the new account. Cost of goods sold went up from 160,000 by 375 to 163.75, then back down when we issued the credit memo by 375 to 160,000. The inventory went from 4,375 down by the 375 for the invoice to the 4,000. Then the credit memo put it back on the books, assuming the inventory was received again. 375 back up to the 4375. If we have the subledger for accounts receivable, what would happen on the subledger customer 4? We invoiced customer 4 by that 525, saying that they owe us money for accounts receivable. We then issued the credit memo, meaning they don't owe us any money anymore, taking it back down to 0, adding up the 4 customers that we have, now adds up back to that, the same, I think it was 2,000. I don't have the total there, but there's the 2,000. That would be the 1,000 plus the 400 plus the 600 for the 2,000. And then the inventory subledger would mean that we got the inventory back, which would be one of those things we'd have to determine when we're trying to figure out exactly what we're going to do with the credit memo. Did we get the inventory back? If so, is it included in inventory in the same amount? We're going to assume it is. That means that we're going to have the 420 here. We got the inventory back, which we put under the purchases, even though it wasn't really a purchase. It's an increase because of the credit memo, in essence, negating what we did before. 15 at the 25, 15 units at a 25 cost gives us that 375. So now we're putting it back on the books, the 15, the 25, the 375. So we were at 75 in units, decreased it by 15 to 60. Then we got the 15 back up to 75. At the $25 cost because there has been no change, and that gives us our 1875, 1,875. That 1,875 of inventory unit 2 plus the inventory unit 1, 2,500 gives us 4,375 on the subsidiary ledger, which ties out to the GL 4,375 as well as to the trial balance and the financial statements. So if we were to see this on the full process, then these two amounts would be recorded as an invoice and then the credit memo. Those documents then, most people note, cannot basically recite what is actually happening if you're dealing with a perpetual inventory system with regards to an invoice or a credit memo. They're just going to rely completely on the software, which is dangerous when you got the credit memo, because you could have those different alterations in terms of what's happening with the inventory and so on and so forth. So if you could understand that process, it's useful. Those two forms then would create something like these transactions, which would then be posted by QuickBooks magically over to the general ledger. Also, as they post to the general ledger, QuickBooks will typically force us to enter the information, which will also allow QuickBooks to populate the subsidiary ledgers, including the customers as we enter the invoice and the credit memo, which it uses to create the accounts receivable subsidiary ledger, as well as the items, which it uses to create the inventory subsidiary ledgers as we do the data input into the system. The general ledger is then used to create the trial balance here, which we broke out in a beginning and ending so we could see the impact of those two specific transactions, the invoice and the credit memo. The trial balance is then used to go to the place that we will typically go to after doing the data input for the invoice and credit memo, that being the financial statements, the balance sheet, and the income statement, which is in balance. Typically, we will enter the invoice and the credit memo, jump on over to the financial statements like the balance sheet and the income statement, check out something over here, say it would be the inventory, for example, and see what the impact on it would be. Then we would double click on it, possibly taking us to the GL type of report, which might be called a transaction detail type of report of some kind, looking something like a general ledger, giving us the detail by the transaction, it going, the credit memo, the invoice taking inventory down, credit memo taking it back up. Then we might say, hey, I'd like to see that inventory broken out by inventory item, at which point we would do something like a subsidiary type of ledger, which in QuickBooks might be an inventory summary report, which would look something like this, breaking out our inventory items into the different inventory items, giving us the units as well as the dollar amounts, then the total dollar amounts of all the units tying into the inventory on the balance sheet, which is why it would be a subsidiary type of ledger. We could do the same thing, of course, for the accounts receivable accounts.